Hello. Going to take a look at merchandise accounting. Okay. So merchandise accounting basically would kind of describe the accounting done by a retail or merchandising type business like Walmart, Target, um, Dillard's, Nordstrom's, any kind of business that buys products from others and then sells them at a higher price in their stores in order to generate profit. That's basically the way that they do business. And one of the things you're going to see is that in accounting, different industries tend to have kind of specific things or maybe a few differences in their business that causes some of their accounting to be done a little differently in response to the nature or the type of business that they do. For example, a retail company will do some things differently than a service company, or maybe a manufacturing company like Ford or General Motors would do things differently than a service company or a retail company. So what you're going to kind of see is that there are some kind of specific things related to each type of industry. And one of the ones again, the one we're going to look at today is merchandising companies. Again, like Walmart, Target, companies of that nature. So, merchandise accounting. There's kind of an operating cycle for this type of business where they basically purchase inventory, they sell that inventory, and they collect from customers. And then that starts all over again. They purchase inventory, sell that inventory, collect from customers, purchase new inventory, and it basically starts all over again. It's a continuous cycle. Now, there's two main types of inventory systems. You've got perpetual and you've got periodic. Now, a perpetual inventory system is basically one where perpetual inventory system basically is one where records are updated as new items come in, and it's updated as items are sold. So as new items come in, they're added to inventory. As items are sold, they're taken away from inventory. And it might be instantaneous, or it might be more maybe on a daily basis. There are some larger retail companies that basically every night when the clock strikes midnight and the new day starts, all the information from the prior day is updated. All the sales, all the new inventory items coming in would all be recognized. So as of, 12:01 a.m., you've got basically all your records are up to date from the prior day. Or it could be instantaneous. If I had a small store and basically I input new inventory as it came in, and as purchases were made, I basically scan the barcode on it and take it out of inventory and recognize the sale. Basically my inventory would be updated as I basically did my business. And so a perpetual inventory system would be one that would be updated as new items come in and updated as sales are made, and it leaves inventory. Now, and that's the main type of system that we're going to look at in this chapter. And really, this is the main type of system that most retail companies use, is really more of a perpetual inventory system. Now, some grocery stores still do kind of a periodic or a type of periodic inventory. But with a periodic inventory system, all inventory is recorded, or basically you would start with your beginning balance. You would record all the purchases coming in during the period, and then you would have to count inventory at the end of the period to see what's still there and what's been sold. So periodic, it's basically not used as much as it used to be. It used to be a pretty predominant method to account for inventory. Like I said, it's still used with some grocery stores, but just not to the extent that it used to be. Now, purchases. What we're going to look at in this chapter is some journal entries and some examples of transactions that look at how would a company account for purchases. And when I talk purchases here, How would a company account for purchasing items to sell in their store? Inventory. Remember, inventory is items that a company holds to sell in their store. So this is looking at how does a company account for purchasing inventory? So first of all, we're just going to look at several different transactions. And these are the transactions that you want to know in terms of here first purchases, and then next we're going to look at sales. So if we had a purchase with no cash discount, let's say we purchase inventory for $4,000, we would simply debit merchandise inventory and we would credit cash. Remember that both of these accounts are assets. An increase to an asset's a debit. We're getting in merchandise inventory, so we're going to debit that. We're paying for it with cash. A decrease to an asset is a credit, so we're going to credit cash. Now, what if we have a cash discount? Or what if we have the ability to take a cash discount? What this means is that a lot of times suppliers, if you're buying goods from them, will offer you discounts for paying them quickly. And think about it this way, kind of as a business, or kind of in terms of a business. You want to get paid as quickly as possible. The quicker that you collect from customers, the more quickly you have the ability to invest those funds back into your business. So the quicker you get paid from customers, the quicker you have the ability to reinvest those funds back in your business. So let's say that we have a purchase with a cash discount. So let's say we purchased 4,000 of inventory on account on January 10th with terms 210 in 30. Now, what these terms mean is that this supplier will give us a 2% discount if we pay them within 10 days. Otherwise, the total is due by 30 days. So we can take a 2% discount in this case if we pay them within 30 days, or if we pay them within 10 days, or we owe the total within 30 days. So the journal entries related to this, and we're looking at this based on the gross method, which is the typical method that's used for this. So that's kind of the method that we're working off of here, the gross method. So on the day on January 10th, whenever this transaction took place, we would have debited merchandise inventory for 4,000, and we would have credited accounts payable for 4,000. And again, we could get a 2% discount if we pay within 10 days in this case, or the net amount is due within 30 days. So what if this was paid on January the 18th and basically falls within the 10-day period so they get the discount? Remember, transaction started on January the 10th. If we receive payment on the 18th, they get the 2% discount. So how would we record receiving that payment? We would debit accounts payable for the full 4,000. Remember the initial transaction, we credited accounts payable. Remember, accounts payable is when you owe money basically in the short term. So we basically would debit accounts payable. We would credit merchandise inventory, and we would credit cash. Now, notice here the credit to merchandise inventory, this represents the discount. And basically how we got that is, if you see my formula up here, I basically took the amount that we paid for the inventory times 2%, and that is $80. Now, notice that I'm crediting merchandise inventory with this entry. Why I'm doing that is if I'm receiving a discount, that means that I'm paying less for the inventory. So basically, if I'm paying less for the inventory, then I need to reduce what I've paid for the inventory with the journal entry. So anytime I pay early and I get a discount, I'm in essence reducing the value of that inventory for what I show on my books. That's how the discount's going to be reflected. And kind of think of it this way. You want inventory on your books to reflect the price that you've paid for it. You want it to reflect the price that you've paid for it. So basically in this case, you would have the discount as a credit to inventory, which reduces the value of the inventory in your books. Because think about it, in this case, you got $4,000 worth of inventory, but you're only paying $3,920 for it. So that's basically why this credit will offset or be offset against the debit here for inventory. And notice the credit to cash here in this payment entry is simply what you owed less the discount is the actual amount of cash that you have to pay out. So again, if you basically recognize a discount, that discount is accounted for as a reduction to inventory balance, and what you're actually paying in cash is the difference between what you owe and basically the discount. That's the actual amount that you're paying there. Okay, so what if basically we paid on February 5th? That would be outside the 10 days. Remember, the initial purchase was on January the 10th. So if we pay on February 10th, that would be outside the 10 days. So there would be no discount. And the transaction would simply be recorded as a debit to accounts payable for $4,000 and a credit to cash for $4,000. So you have to pay within the specified time period to get the discount. And this is basically how you would account for that transaction. Otherwise, you simply pay the full amount if you do not pay within the discount period. Now, purchases with returns and allowances. Basically, company receives an allowance for $500 for damaged merchandise. So basically what we would do, what this is, what returns and allowances are, is we have the ability, if we're buying goods from a supplier to sell in our store, we have the ability to return them, or maybe if they're damaged in shipment, we could basically contact the supplier and say, look, they were damaged. We can't sell them for full price, but we'd like to keep them. Can you give us a discount on them? And that's basically what an allowance is. They're basically giving us a discount because typically they were damaged in shipment or something with them. So company receives an allowance of $500 for damaged merchandise. So basically, you would debit accounts payable because you will no longer owe that supplier money for those goods, and you would credit merchandise inventory. Again, you want inventory on your books to reflect the value of what you paid for it. So if you're getting an allowance, you're basically reducing the value of the inventory on your books, and that's how it would be reflected here with this journal entry. So let's say we return goods with a value of $2,000. Then we would debit accounts payable because we no longer owe that supplier for them. We would credit merchandise inventory. And in the case of a return, this is where we are shipping the items or having them sent back to the seller, the supplier to us. Now, watch out for returns and allowances in relation to discounts. And what I mean by this is, what if we purchase $5,000 of inventory on account with terms 210 net 30 on January 15th? So on January 15th, we'd debit merchandise inventory, we'd credit accounts payable. This is what we would do to set up or initiate the transaction. Let's say we return $1,000 worth of inventory 3 days later. So we'd debit accounts payable for $1,000. We'd credit merchandise inventory for $1,000. We no longer own that inventory and it's been shipped back to the supplier. We pay the supplier in full on January 24th. That falls within 10 days, so we've earned the discount. So notice our entry here. We're going to debit accounts payable for $4,000. And think of it this way too. Here's kind of a way to think about this part of it too, is that if we're paying the supplier in full, we're going to take away or zero the balance in that account. And so then we would credit merchandise inventory for, in this case, 2% of what we owe. So we'd take the 2% of the $4,000 would be $80, credit to merchandise inventory. And again, our cash payment would be simply what we owed less the discount. This would be the actual amount of cash that we paid to that supplier. So notice here that if we return merchandise, it's basically going to reduce the amount that we pay, and that'll be reflected in our journal entry whenever we record the payment to that supplier. Now, purchases with transportation cost. If we have to pay for shipping, such as what if we need to order like and have it overnighted to us? There might be some additional fees related to that. Then basically, if we have to like pay for shipping, like in this example here, pay for shipping $100, we would debit merchandise inventory and credit cash. Now, the reason that we're debiting merchandise inventory is because if we have to pay for shipping, we have increased the cost of that inventory. And so we're going to debit and increase the value of that inventory on our books. Now, so that's basically the journal entries related to purchasing inventory to sell in your retail store. Now, let's look at how we would do sales. So let's say we sell inventory with a cost of $500 for $1,200. So we've kind of crossed over now, and we're looking at how do we record sales? And there's no discounts involved in this one. So basically, whenever you make a sale, you record the sale. So we debit cash, we'd credit sales. So we record the sale, debit cash, credit sales. And then we would record the cost of the merchandise. So notice here that we're debiting cost of goods sold and we're crediting merchandise inventory. Debit cost of goods sold, credit merchandise inventory right here. This is basically how we would record the sale. 2 entries, record the sale, take the merchandise out of inventory. Now, there's a new account here called cost of goods sold that you haven't seen before. And cost of goods sold represents the cost of any inventory items that are being sold. The cost of any inventory items that are being sold. So, sales with the discounts. So, in the same way with purchases, where we looked at, okay, we've got a purchase and, we receive a discount if we pay early. A lot of companies offer that same type of system to their customers. Because again, the quicker you get paid, the quicker you can reinvest those funds back into the business. So if we sell inventory with a cost of $500 for $1,200 on account with terms 210 and 30 on January 10th, on January 10th, we would record it as a debit to accounts receivable and a credit to sales. And this would be our entry we'd do to record the sale. And then we'd debit cost of goods sold, we'd credit merchandise inventory, and this would be our cost where we recognize basically taking the goods out of inventory and the expense that we paid for that inventory. So cost of goods sold is an expense account, and it represents the cost of the inventory item sold to you, your cost of that inventory item that was sold as a business. So what if we receive payment on January the 19th? Then basically that customer would receive the discount. So basically we would basically credit accounts receivable, and the amount of discount, if it's a 2% discount in this case, we'd take 2% of the total amount that was owed to us. And so basically we would debit cash for the amount owed less the discount. Notice we'd record the discount to an account called sales discounts. I'll get to that in just a moment. And we would credit accounts receivable for the full amount that customer owes us, because in this case, that customer is paying us in full and no longer owes us the money. So debit cash for what we receive, credit accounts receivable for what the customer owes us, and basically the discount would simply be the difference in what they owe us, and less the discount is what we're being paid. Now, what if they pay on January 31st? There would be no discount. So it would just be a debit to cash and a credit to accounts receivable for $1,200. There would be no discount involved. Now, the sales discount account, what you're going to see, and we'll look at this a little bit deeper in just a moment, is the sales discount is an account that represents the amount of discounts given to customers. And one of the things you're going to see is that by breaking out discounts into the discount account and by breaking out returns and allowances into a separate account, you're better able to see your total sales, how many discounts are being taken, and how much items are being returned. Instead of kind of putting it all back into the one sales account, they're breaking it out to give company leadership better information about customers using discounts and about the amount of items being returned. It allows them to do that. So speaking of returns, let's look at returns. So sales returns and allowances. This is basically, again, when customers return items to you. You sold it to them, they bring it back, which is a normal part of business. So customer returns goods costing $200 that were sold for $500 on account. So we would debit sales returns and allowances. We'd credit accounts receivable for $500. We would debit merchandise inventory for $200 and credit cost of goods sold for $200. Now, one thing to look at, these are the entries that are related to a return. The first one looks at reversing the sale. The second one looks at reversing, basically putting the item back into inventory for it to be sold again. If you notice, this entry is just the opposite of what we do to record the sale, except sales returns and allowances takes the place of the sales account. But it's everything we do to the opposite of everything we do to record the sale and take it out of inventory, except sales returns and allowances replaces the sales account. That's the only difference. So the sales returns and allowances account, again, kind of like I said with sales discounts, this is a way to break out that activity to where users of the financial statements can better understand the meaning behind that activity or basically what that activity means. They can easily look at the financial statements and see, oh, how much has been returned, or to see if too much has been returned, basically. What if the goods returned are defective? Now, in this last example here, when they were returned, we were able to put them right back on the shelf. We were able to put them right back on the shelf. But what if they're defective? What if we can't do that? Or maybe they're damaged? Do we have to sell them for a lower price? So in the example above, what if the return goods were damaged and only worth $50? Then we would reverse the sale, much like what we did up above with debit sales returns and allowances, credit accounts receivable. But notice how we would handle the damaged merchandise here. We would debit merchandise inventory for $50, which, remember I said that is what the damaged merchandise is worth now. We would credit cost of goods sold for the $200, and the difference would be here a loss from defective merchandise. This is a case where it was damaged, and basically we can't sell it for full price, so we're just going to put it out on the shelves and just try to get what it's worth. In this case, $50. This is how we would handle that. Now, what if a buyer is granted an allowance? Remember, we looked at an allowance back with purchases. An allowance basically is where goods are worth so much, or basically goods are damaged in shipment. Typically, that's when you see this. And they call you, send you a picture, say it was damaged in shipment. You say, well, I'll give you so much off if you'll keep it. And so that's basically what we're looking at here, an allowance, very similar to what we looked at again with purchases a moment ago. So buyer granted a $200 allowance as goods were damaged in shipment. We'd again debit sales returns and allowances. We'd credit accounts receivable. In the case of an allowance, there's no journal entry related to inventory because the inventory is not being returned. So again, this would be the only journal entry you would need to make. Now, inventory shrinkage. relates to stolen merchandise and damaged merchandise. And here's kind of what you think about it. A company does a physical count. They complete the physical count and must write down inventory. Now, a company does a physical count because kind of think of it this way. All the activity related to inventory happens within the system. New items come in, they're added to inventory balance in the system. Items are sold, they're taken out of inventory in the system. So kind of think of it this way, as all the inventory activity is accounted for within the system. But things like damaged and stolen inventory are not accounted for anywhere in the system. So companies tend to do a physical inventory count 1 or 2 times a year, sometimes maybe even quarterly, 4 times a year. And they typically then write down what the books or the system says to what they've actually got, which is what they've actually got is what the count told them that they had. So let's say a company does a physical inventory and basically must write down their inventory by $1,000. Their actual total was $1,000 less than what was showing in the system. And again, this is typically due to stolen merchandise or damaged merchandise. So the company would do an entry where they debit cost of goods sold and they credit merchandise inventory, because they need to, if they've shown this much on their books, but they've only got this much, they need to write it down to where the system is equal to what they've actually got. So these are some examples of how a retail company would handle journal entries related to purchasing items to sell in their stores or inventory, and basically selling those items to customers.